shadow credit alarm, opacity, valuations, and the risk of a wider crisis. Private credit and shadow banking are under intense scrutiny, uh, not because of one headline failure, but because of systemic opacity, questionable valuations, and rising exposure to low-quality borrowers. After the initial shock, hedge fund redemptions, early frauds, and cockroaches, the core problem remains. We lack reliable information about who lent to whom, what collateral exists, and what those positions are truly worth. Key points, condensed. Structure and vulnerability. Shadow banks, non-depository lenders, credit funds, etc. aren't regulated like banks, so they don't have mandated disclosures. Their investors are qualified institutions or wealthy individuals, while regulated banks often supply leverage and funding via wholesale markets. Repo. That funding link creates contagion channels to the regulated system. Nature of the assets. This cycle's risky loans concentrate in zombie corporates, securitized consumer products, cards, autos, and bespoke collateralized deals. Many positions are illiquid and privately priced, effectively level 3 assets, relying on internal black box models and subjective marks. Valuation risk and incentives. Ratings and internal marks can mask losses. Agencies and fund managers may understate defaults or employ selective accounting, continuation vehicles, or intra-fund transfers to hide weak assets or boost fees. This mark-to-myth problem raises conflict of interest and DOJ/regulator attention. Warning signs. Prominent investors and commentators, PIMCO CIO, Bloomberg editorial, Bank of England officials, have flagged garbage lending and dubious ratings. Research shows banks with the most non-bank exposure are also those most dependent on market funding, amplifying runoff risk if confidence collapses. Information asymmetry. The industry's reflex is reassurance. Portfolios are stout, but refusal or inability to provide audits and honest samples fuels distrust. Without transparent sampling or legitimate audits, markets will price in uncertainty, not fundamentals. Pathways to trouble. A modest economic softening, flatter growth, job losses concentrated among small firms, can push default rates higher. As doubts about marks spread, liquidity can evaporate in wholesale, funding, and secondary trading, triggering forced selling and a feedback loop beyond private credit into banks and markets. How this differs from 2008 and how it's similar. Not the same mortgage pools, but similar mechanics. Opaque securitizations, wholesale funding reliance, hidden leverage, and ratings dependence. The difference is scale and structure. The similarity is human incentives and weak disclosure. Practical takeaways, demand transparency. Meaningful audits or sample disclosures would materially reduce tail risk. Avoid overexposure to privately priced, illiquid credit and continuation vehicles. Watch macro softening indicators, employment, small business stress, and insider/sovereign funding shifts as early warning signals. Recognize that regulated banks' continued exposure to non-banks is a key contagion vector. Bottom line, there's smoke, maybe not a raging fire yet. But because private credit is opaque, subjective, and increasingly tied into wholesale funding, a modest downturn could convert valuation doubts into systemic stress. Transparency, scrutiny, and defensive positioning matter now.